Good morning, everybody. My name is Glenn Chiveni. I'm a principal in the firm GRCH Architecture. We're very lucky to have a very distinguished panel here today of developers. We do have three presently. We have Anthony Bartone of the Bartone Terwilliger Group. We have Nick Halstead of Mill Creek and Mike Dove of the Beechwood Organization. Glenn. Oh, I tried for Mike and I got I might lose him as a client. And Chris, we're waiting on. We're not sure if he's going to be here. So I see Anthony has got a presentation set up, and that's terrific. So this is a workshop for Nassau County of top projects underway. And what we've written under the explanation for it, which I underlined, was increased economic development, quality life of residents, business, and visitors. And I think those are the key elements to allow the projects you can hear today of what they bring to a community once they are developed. So we'll start with Anthony Bartone.
Thanks. I did a quick PowerPoint because I like monkeying around with the computer, and this way you don't have to listen to me so much. You can just look at the pretty pictures. It's much better. So I'll be brief because I think one of the benefits of these types of forums is the interactive dialogue that we can have on the projects and what's going on in Nassau County. Again, my name is Anthony Bartone. I'm the managing partner at Terwilliger and Bartone Properties. My partner, many at the table will know, and some in the development community, is Ron and Fran Terwilliger, very successful developers on a national platform. They were the bosses at Trammell Crow and a number of other entities. We've been fortunate to partner with them here on a local level here on Long Island. And I'm just going to talk real quick just to introduce who we are with some of the things we've done in the village of Farmingdale with their revitalization, and it's gotten a lot of good press, and Mayor Ekstrom was on the panel this morning. But that's what I'll just speak on for a couple minutes here, and then I'll turn it over. The village of Farmingdale went through an extensive master planning endeavor. It took probably upwards of a decade. We tried to stay true, and we did stay true to the master plan as it was designed. The epicenter for the plan was the train station. Many would say that Farmingdale's waterfront was its train. That was the epicenter of the whole community. So what we focused on is the transit-oriented development around the train station, specifically in 3 phases, which you can see here. This being the train station right here. Here is Main Street, Farmingdale. So we focused on these 3 buildings, phase 1, phase 2, and phase 3, with a mixed-use product that centered around the train. We like to say transit-oriented development is such where it's kind of defined as if you could walk to a transit hub, you're transit-oriented. Well, we like to say we're TOD with a capital T because our residents enjoy the benefit of waiting in the lobby of their buildings for the train. Here's the train station, here's the platform. So they wait in the lobby of the building to take the train. This is some of the artist renderings of the products as you were looking at the train down Secretog Avenue. Secretog leads to Hempstead Turnpike, which is Conklin Street. So again, these 2 buildings, phase 1 and phase 2, are the mixed-use buildings. On the ground floor, there's retail, 20,000 square feet of retail, and residential apartments above. These 2 phases have 154 residential apartments. We were fortunate to attract both very strong regional and national retailers to our retail. We have Starbucks anchoring us here on the corner, right at the train station being here. We have the George Martin Group under construction right now, a GM Burger Bar. We have Toa Sushi, they have locations in Huntington, and they have Mocha in Woodbury. We have a regional salon and spa over on the corner. And then as you move away from the train station, then we have other ancillary uses. We have a dentist's office and other service-oriented uses. That's a pretty good-looking building right there. Way to go. The designers are sitting at the end there, Lou got on the knoll. So. This is phase 3 of the development, the cornerstone. This is exclusively residential. This is on the north side of the tracks, and this has 42 residential units. So I'll just, you'll hear myself and all of our colleagues speak about pent-up demand. Well, this kind of says it all. We opened up each one of those 3 phases. The day we opened, we were 50% leased. That building was 100% 3 months after opening. All the buildings around the train are 97 to 100%. So if you want to speak on demand and an absence of supply, the numbers speak for themselves. This is just a montage of the actual photos of the buildings, again, with the our historic train station being at the center. These are the actual buildings as they exist today. This replaced industrial blighted warehouses.
Space while creating financeable projects that has all those other benefits of providing the different housing stock that millennials and empty nesters want, that then in turn creates more sales tax revenues and revitalize downtown. So you can't really start the positive churn until we can get the project off the ground in the first place. And the IDAs provide the financial benefits that we need, but also the predictability that our investors require.
I have sort of 2 quick questions for you, Nick. As far as the retail in the Mineola project in Moderna, how many square feet do you have? What's the deal there? What kind of retailers do you have?
We actually don't have retail at Moderna Mineola. The ground floor is it's a part of our housing that it has packaging. It's built to kind of keep the streetscape, like pedestrian friendly, but that's like where our fitness center is located, our clubroom spaces. It's all built into our ground floor amenity package for residents.
Is there any retail planned in the next phase we're talking about?
The next phase is it's not in a main corridor where retail would be viable, but we're always looking at mixed use opportunities. It's just in these particular cases, retail wasn't considered in that particular location.
Okay, and then just a quick question about Farmingdale. Do you guys have any projects on the 4th Main Street? I thought I saw some stuff lit up in the picture there.
Yep. Well, we are currently under construction on the first for sale product, which is the town of Hartstone Townhome. Farmingdale has a project under construction on Main Street, 23-ish, 27 units, I'm not sure exactly, mid-20s. Mixed use retail on the ground floor and apartment book. And then there's been significant other redevelopment on Main Street, more site specific in that, for instance, that Meatball Place, which wasn't Patchogue, opened up a location for them. They did a very significant renovation. We see some of that as well. But regards to what you saw on the master plan, yes, there's a project currently under construction. But comparatively, it's smaller, 20 some odd units.
But that has retail?
That has retail.
And that's part of your
That's
organization?
not us.
Because I know, I wasn't sure if that was you guys or someone else.
That's somebody else. If it was us, it'd be none of it. I didn't mean to say that.
Well, we got to make America great over there.
9 months. 9 months. You had a question?
Yeah, Anthony, I was very impressed by some of the facts that you have. I'm Sharon Mullen from Long Island Housing Partnership. And one of the things that struck me about looking at the project was how much parking you were required to put in and the fact that it's not used. I think it would be really helpful if you guys would do fact sheets on some of these as to, what the real parking usage is and the traffic concerns, and to refute some of the, opposition to building housing in downtowns, because in reality, you're not impacting the school system. That was a wonderful sheet that you had. But it would be interesting to see, just from the perspective, you could have put units in there instead of parking lot. And you couldn't be any closer to the train station. The train is practically coming through the building. So, it is walkable. And I think that these regulations and planning documents were from another era and don't represent what we do today.
Well, why would you let the facts get in the way? That seems to be the resonating theme when you go to the public hearings.
Yeah.
And so we stated all of those statistics ad nauseum as we were presenting. And we say, well, what's the biggest waste of space we can have on Long Island? Is an empty parking lot with tumbleweeds blowing through it, which makes no sense. We present all the data every day, all of us do. And the public just does not, they do not, for whatever reason, I don't know if they think we're the big evil developers or what the perception is, but regardless of how many times we say these are not forecasts. They're real-time statistics, doesn't matter. So the elected officials are challenged. You know, they're sitting on the board and they have to do what's right for the whole community, and obviously they get it because they read the 10,000-page studies and they're part of it, but the public often doesn't, and so that's where you find, you know, the balance and the approvals. But we do. We present those statistics all the time, and they often fall on deaf ears with the public. Not the elected officials, but they have to find, you know, a middle ground.
Yeah, I'll jump in quick on that too. I think when these first TOD developments were proposed on Long Island, it was hypothetical traffic counts, and it was hypothetical everything. And you know, the argument then was, show me the data. And now you show them the data, and they're like, I don't believe it. We parked Modera Mineola at 1.7 spaces per home. I believe we're at 1.2, 1.3 of actual usage, and that's a lot of money that's, you know, could have been put elsewhere into the project. You know, so we're exploring different ways to affect that. We have garage tracker counts, so we know how many people are coming in and out at different times of the day, so we literally can show you there is no real peak impact at these, you know, high traffic hours. But again, sometimes the data falls on deaf ears.
Can I speak to that as a public, antiquated thinking person? I'm planning commissioner in Nassau County, and one of the things we're concerned about the most is parking and traffic. And we know that from everybody go to Huntington, Port Washington, any of the Rockville Center. So you don't always know where you're gonna get that hot spot, you know, beforehand. And then after the fact, it's too late. So the impact on the environment is a very big concern, and also the way it feels to residents to have that kind of traffic monitoring. So it is one of the priorities in the current operation.
I just want to mention something, though, to your point. You never brought up Uber, Lyft. The world has changed so much. So to your point of needing less cars, it's clear as a bell. People take their phone out now. They don't even want the insurance still. Where am I going to park? They're happy with Uber and Lyft.
There's one more other thing, we also, on the commission, we also take into consideration, special retail and restaurants, they want to do valet. So we actually reduce the parking spaces.
And do you also allow usage of your municipal lots?
Nassau County.
Do you allow usage of your municipal lots to count towards development?
Yes, we take that into consideration, absolutely. Absolutely. So if there's not enough on the property, and as long as there's parking in the area, I'm also, like, me for one, will not allow parking to spill over to residential areas. I wouldn't vote on it. I think that's awful. Even with churches, which, you know, and synagogues, it's a hard thing, especially on Sunday mornings, when you can't even get out of your own driveway because of so much parking and traffic.
You know, the comment about Huntington reminds me of Yogi Berra saying that he said nobody goes there anymore because it's too crowded. And we were there about 3 or 4 weeks ago to go to a restaurant with friends, and you drive around and around and around looking for parking, and yet Huntington had a proposal which they rescinded to build parking. The town of Huntington had a proposal, an RFP, to build parking. However, it was so restrictive, and I was talking about this earlier in Anthony, that there was no way to make it profitable for a developer, regardless of how many units of residential or how many square feet of retail could have been provided. So if Huntington had just been a little more realistic, I guess is the word, in their RFP, I think that would have been a successful project. But then it would have lent more to the traffic issue. But at the same time, the downtown of Huntington, which is very vibrant, is going to start suffering because people are going to stop going.
And parking structures are generally looked at as being ugly, but they don't have to be ugly. You see them
No,
all
not
over
at
the
all.
country.
You
They're
can-
quite attractive, and it's no different than building an office building if you do it right.
They
You
don't
can line
have
the
to
traffic, you can line them with retail or residential or townhomes, and so you can, there's a terminology called a Texas donut, which is not done in this area, but the parking garage actually fits in the middle of the development, and the development goes around the outside of the exterior. So you don't see the parking garage, but what you do see is all the residential or retail as part of the development. But somehow we don't seem to be ready for that yet on Long Island.
I think there's also a fundamental difference between design and economics. I mean, you can make a parking garage great, but if if it's free parking or 25 cents an hour, and I've got to replace municipal parking and then also park my own development at 1.5 spaces, it's just the numbers don't add up.
You had a question, Ms.?
I was just wondering, for the two developments, Anthony and Stephen, one in East Rockaway and the townhomes you're putting up in Farmingdale, the cost of a townhouse.
That was the first thing I asked him when he sat down too. That was such a good question. Ours, we start at $399.9, so we are pricing them aggressively at what we perceive to be an entry level or a downsizing unit, as Stephen alluded to. So like with ours, you have a garage, 1,700 square feet, 2 bed, blah, 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 and they started at $399.9.
In East Rockaway, they're from the mid-4s to the mid-6s.
That's for Long Island.
Right,
For Long
right.
Island, it's pretty reasonable.
It's actually, and this is typical of Nassau and Suffolk County, it's not the sticker price on the house that gives people sticker shock, it's the taxes. Taxes are a real problem for both counties. They put downward pressure on housing prices and on investment.
What would be the taxes and the carrying charges on that property?
Taxes are about 2.5% of the purchase price, and the carrying charges, I believe, are about $400 or $500 a month.
Makes it pretty,
It's tough.
reach.
We build, it's not Nassau County Road and Bridge, we build single-family homes for families that are priced between $400,000 and $500,000. And we want to build houses that we can sell to cops and firemen and, you know, the everyday person. And it's tough to afford $15,000 a year in taxes. It's a real problem. And just to get back to the pilot, if the pilots go away, you'll see a lot less development because they make projects feasible. Like Nick said, we have a pilot on a Vanderbilt project. If we didn't get it, we weren't financing that building, we weren't going to build that building. So they get a lot of bad press. I saw a statistic that the Long Island IDA's programs, the pilots, and other benefits that they gave away encouraged $9 billion in investment, and the benefits they gave away were way, way less than that, well under $1 billion. So they get bad press. I don't know about the Green Acres project, but I think when they're done correctly, they're a really good use of the benefits, and they're good for all Long Islanders.
Yeah, on this note, I was just wondering if you guys were doing anything to like target young people who are trying to establish themselves on Long Island, because like as a college student looking for an apartment, it's either luxury homes that are worth like $3,000 for a studio apartment or like $800 apartments that were built like 100 years ago. So I was just wondering, yeah, if you guys were doing anything to, you know, target students.
Yeah, so why don't you each speak to that?
Yeah, well,
Percentage of units that have to work for.
yeah, well, as we mentioned, like on ours with the TOD project, Farmingdale, 20% of units went by lottery at affordable rates for those making a certain income. So we have that, but what I tried to touch upon, and $3,000 a month for a studio would be great. But we're not there yet. But you're right. You see studios that could be upwards of in the $2,000 a month range, and that can be expensive. But what everybody doesn't understand is you just heard Stephen talking about, and I like that 2.5%. I had to do the math, carry the one, you know, rather than just sitting that number, which almost takes your breath away for the taxes. You know, when you talk about those taxes and you talk about the cost to get into the house, down payments and closing costs and all that stuff, it's tens of thousands of dollars. That's where, in my opinion at least, one of the real hurdles is. So like with our product, for instance, I know it's consistent with Nick's, is that you can get into a studio for around $2,000 a month. When we're going through lease up, you get a month free and it's $500 security, $100 application, and you're in the door. $600, you're in the door, and you're off. So when you amortize, if you will, or spread out the cost over you, it is very affordable. And then we also have 2-bedroom products, which we design, and I know Nick does too, where it's a dual master, if you will. So you could have 2 people in the one unit. So that's, for instance, around $3,000 a month. You can divide that by 2, it's $1,500. You have your parking there. You have your gym membership because it's part of the building. You have all those things. So when you bake it in, it does, even the market rate units become a little more attainable. And then when you supplement that with the ones that go via lottery, 20% of the unit, 10% or 20 units go by lottery, we believe that we are working good. Was there one thing? Oh, okay.
Yeah, we have 10% affordable housing, it's workforce housing, 80% of area median income at our new project that's going to be coming online soon. But other ways that we kind of try to increase the kind of the realistic affordability, we, for, at least for couples or roommates, we maybe have a one-car lifestyle because it's walkable, so you can kind of reduce some of your overall, just budget cost with, maybe one less car. Also, we do junior one-bedrooms, we do studios that are a little bit more efficiently laid out and can be smaller in size, so even though the per square foot rents are high enough for our investors and to make our pro formas work, and on the aggregate level, they're approaching affordable even at market rents, just with better design of units themselves.
Just real quick, on that 10% of almost every project we build is affordable. An example is Huntington Station. We're building 76 homes, 11 are affordable. The lottery for the 11 affordable homes was something like 200 names. There's tremendous demand for it. There's no easy answer, and there's probably no good answer, because Long Island's a high-cost area. It costs a lot of money to build a house. Every year, from a builder's point of view, building codes and regulations become heavier and heavier and add more and more cost to us to build a house or an apartment or building. And then you've got the factor of taxes and high land prices. So it's tough to build housing that's affordable, that's not mandated by the government or the towns. The one thing I'll say is I think, unlike 10 years ago where very few new projects were getting approved, there have been rental housing developments and for sale housing developments approved and have started to be built and leased up over the last, Madera is an example, Patchogue, Wyandanch. I think there's a little bit of a thaw, and Long Islanders are going to see that these projects are not as bad as they imagine, and hopefully that opens the door to wider development, and more supply will bring down prices.
I'll just add one quick thing to that too. I mean, the more market rate development we can build on Long Island, the more we have a cross subsidy to provide that affordable housing. So, I think we need forums like this to, increase the public perception, positive public perception of these developments as a whole. And by definition, we can provide that affordable housing along with it.
Across those rental projects you guys have, first-time home buyer, I understand that, but have you seen, it depends who you talk to, like, what would you say outside of the affordable housing is the typical profile? Is it the empty nester, is it the working professional, like the 50-50, or what are you guys seeing in real time with your tenants?
We kind of, in Mill Creek, we internally discussed kind of this concept of a barbell demographic, where we do have roughly 70% of our residential base are kind of evenly split between millennials that are moving out to a market. Largely, they have some historical ties to Long Island. They grew up and are coming back, or they're the empty nesters that are downsizing but want to stay within their community. So I think that those are the two biggest demographic cohorts, and then you kind of have a mix of the remaining 30% of that.
I'm going to use that. I like that. That's spot on for those two.
The condominium projects, are you seeing any pushback from, is it an issue for people getting financing?
So far, no. I was just talking to somebody about how the 10-year Treasury has gone up 60 basis points since Trump was elected, and I think if rates go up, that's going to put downward pressure on home sales. It's going to make it tougher for first-time home buyers who are very sensitive to mortgage rates to buy homes. When we sell houses to empty nesters who have built up a ton of equity in the home that they're selling before they move into ours, they're not as sensitive to that because they're buying either all cash or with a very small mortgage. So we'll see.
Are there any other questions?
Well, you have us for another 15 minutes, so everybody can go. There we go.
I don't know the total facts of me bringing up about Valley Stream and Green Acres, but part of it is what I was saying, it's not anything really with the pilot, but it wasn't expressed in the press or people exaggerated politically. It was this really a tax sorority on a whole shopping center, and it's millions of dollars that had to go back, and that's recouping that. But it's getting lost in the conversation that it's just a pilot, like some scheme or something. That's what I was saying.
You have another question?
Actually, one very I wanted to know, from your perspective, you have a formula that you go by, or you just go for broke when you're trying to pitch a pilot program, where you need to be, especially depending on the area, obviously. Because that seems to be a big issue. All the IDAs are completely different. And if they really don't want you to come in, they're going to give you a really bad deal. If they really want you, they obviously give you a bigger deal. But where did you place your numbers? Where does it make sense?
I'll take a shot at that. When we approach it, we just asked for, and we've only done it once with our Vanderbilt project, we asked for what we felt we needed in order to get the building financed.
Can you speak louder?
Sure. When we approached it with the Vanderbilt, we looked at it and asked for the bare minimum we felt we needed in order to get the building financed. For us, everything we do is our own money and third-party conventional commercial bank financing. And bank financing has gotten tougher and tougher over the last years, despite the fact that the economy has improved and fundamentals have improved. Our attitude, our approach to it was just to ask for what was needed, because in our business, moving fast means making money, and we didn't want to get into a protracted negotiation. We wanted to go through it as easily as possible and not be accused of asking for more than was needed. So we got the process done very quickly because I think we asked for something that was less than what the IDA typically gives out.
Yeah, I would echo that. There's more science in all of this than you think. Nothing is throwing a dart at anything. So when we're analyzing projects, I'm sure everybody at the table does the same thing. We look at the precedents, we look at what's typical, and then we see if it'll work. And often we'll back into what can be tolerated to pay for the land, and what can be tolerated economically. And we're working on single basis points movement one way or another. There's really a significant amount of science. And Stephen and the Beechwood organization, they're a very, very large presence here regionally, if not nationally. We just recently, talking on financing, just went back into the for sale market with our small 24-unit townhome deal. And let me just tell you, the financing for a developer was non-existent. It's not that it was difficult to attain, it didn't exist, period, the end. Again, when you have the track record and the girth that the Beechwood organization has, the conversation might be a little different. I'm sure they struggle with it as we do. For us, it wasn't even there. So now you find out you have to go for more equity investors, you have to go to alternative lenders and different capital sources, which gets very expensive. And so it's a whole pot of formulas, moving pieces and whatnot. But it's very much, there's a tremendous amount of science that goes behind it. And to the point that everybody made, if those numbers via the pilot or what have you aren't there, we just can't move forward with the project. And that's not us. We can't rally the capital from anybody. It doesn't matter. So the project just doesn't go. There's a lot of science to it.
Pete, can you say what your opinion as to why it's not there anymore, the bank money, for you?
For me?
Yeah.
Well, I mean, look, we're all shell-shocked from the Great Recession. I got my butt kicked. I mean, let me tell you, we came this close to going out. We're a small local player. And I'm not ashamed to admit that. Many people in the room and in this building and everywhere. Yeah, right, exactly. So, we understand there's all sorts of new regulations that were born from that, many of which are not very good. And so we understand the apprehension in the capital markets that we all want to be smarter. But, you look at when the bubble burst, the leverage that us as developers were putting on deal, you're up in the 90% range of leverage between different layers of debt. Now you can only maximum put 60% leverage on a deal, in my opinion. You guys would probably agree, I would think. So that puts a 40% equity burden on a project. So just real quick, when you talk about a $50 million deal, 40% in cash. It's like, well, hold on a minute, it's like it's a massive burden. And then on a for sale product, like I said, the banks just don't have the appetite for it. I can't speak on why. I mean, but but it makes it extraordinarily difficult. And that's after we've gone through all the joys of entitling the project for multi-years, 2, 3, 4, 5 years. So we've done that, we've played that fun game. Now we come to the capital markets, we've speculated out 2 and 3 years as we're going through entitlements, trying to speculate what the rates will be. As he's saying, they move so much, 60 basis points in a matter of weeks. So we're trying to forecast out multi-years. And then now you come to the capital markets and it's the law school.
I think in our experience, it's been regulation of the banks by the federal government, by state regulators. There's just, every year it seems there's new regulations that come into play. A lot of them, like Anthony said, don't make sense. The latest sort of devil to us is a rule called HVCRE that requires that the developer have at least 15% equity in the deal, not for what it costs when they buy it, but for what the as stabilized value is when it's projected to be completed. So if you buy land right, which is a hypothetical example, you buy something for 10 million, but when the building's completed, it's supposed to be worth 30 million. They don't want 15% of 10 million, they want 15% of 30 million. So you're penalized for buying land right. On top of that, different banks interpret the regulations in different ways. So you can't get a straight answer, you don't know what to expect. It makes it tough to plan developments, it makes it tough to project what sort of financing and equity you're going to have to allocate. And the other thing I've seen as a result of the regulation is over the last 8 years, you used to be able to go out to different banks and get different terms. There was a little bit of an entrepreneurial approach to it. The banks have been so regulated that everything's become commoditized. So to what Anthony said, you generally are going to get the same terms from every bank now that you go out to. It's very rare that somebody gives you different terms than the other 3 guys. And it's really been, in a way, I think the industry has been nationalized sort of quietly because they're taking their orders from federal regulators. And I'm not saying that all regulation is bad, it certainly isn't. But the level of regulation that banks are under right now really puts a damper on our business and makes it very tough.
And I think the lending terms are, to echo that point, are pretty static nationwide. We are underwriting 60% leverage, which is 40% coming out of pocket. So in equity, and I think that there's conversations in the market about how the market is mature and there's oversupply issues, but that's just not the case on Long Island. So we've got a line of tenants out the door. The second we get a project approved and are ready to start building. So, it's a little frustrating at times that it's so hard to attract capital in a market that is as supply constrained as Long Island is.
I'm just sitting here wondering, if you're gentlemen, do you think there's anything, since we kind of brought them up earlier, that our new developer in chief will do, Trump, to make the developer's life easier moving forward? Is there anything you're excited about, regulations that might change, or?
I think the big thing everybody talks about is just infrastructure investments. If that can actually, what was proposed under an Obama administration maybe has legs in the Trump administration because he's got Congress working with him. That opens up new areas for higher density development and you have the infrastructure in place to support it. So I think that indirectly is something that should be watched in the coming years.
I have no idea what he's going to do. I'm hopeful that there's a better attitude towards regulation because I think it's gotten past the point where it needs to be. So maybe that can be dialed back a little bit, and I think that'd be good for our business.
And I would agree. I think his philosophy is such, and I think this will everybody because his philosophy is very much a pro-business and under-regulated, or not relaxing of the regulations. So, I mean, we're optimistic, but tomorrow who knows.
Any other questions? Does anybody on the board want a final say? All right, just make sure you tell Eric Alexander this was the best pound.